If you've ever wondered about how to use all of the different rules inside of Sequence and the right rules for the right scenarios that you're going through, well, this video is for you because today I'm going to walk you through every single rule that we have inside of Sequence, how to use them, what they're best for, and what rules you want to make sure to avoid in certain situations. So with that, let's dive into this situation. What I've built out here is a really basic map to get started. One of the maps that we tend to recommend for most of our new users just to get the basics solved. And in this map, this is for an individual or for a couple, not a business owner, but we'll talk about business owners as well. In this case, we've created our income source. So this is, again, the account where the money will be landing from their paychecks. We've also synced their emergency savings fund, which in this case is a money market. You'll note it says destination only, and we'll cover that here in a bit, and the different rules that result when it's a destination only account. We've connected their external checking account. We've also created a pod, and you can tell that because it's purple, new account, a new checking account for discretionary spending, as well as one for surplus, because the whole goal of just getting started for most of our users is to help differentiate your spending. Having an account or a bucket of money for your fixed expenses and your bills, having one for your lifestyle and flexible spending, and then having a surplus bucket that we can eventually sweep into the goals that you have, whether that's eliminating more debt, investing more money, or some other combination of those two. So in this case, we have not created any rules. We've just simply synced our two external accounts. We've created two new goal accounts in the forms of discretionary spending and our surplus account, and we've created our income source. Now, when it comes to creating rules, we've got a couple different ways to do that. Obviously, we can always click the plus button and drag it. You'll also see a couple other places, this new automation tool right here where we can create a single rule or we can start with a template. Again, this creating a single rule will have the same impact as us clicking and dragging a rule. Or if you ever need to do a one-time transfer, which we'll cover, you can always click that in the top right corner and instantly transfer money between any of the accounts that you have on your map. So to get started, what I'm going to be doing is I'm going to be clicking and dragging to our emergency savings account. And now I can trigger these rules on a couple different criteria. I can trigger it every single time money hits the account. That's this first one, trigger by incoming funds. So it doesn't matter if it's $5 or $50,000. Every single time money hits the account, you can send it. That is best if you are doing all of your rules based on percentages. So anytime money hits your account, you want 10% to go to your emergency fund, 30% to go to your wants, 50% to go to your needs, something like that. Trigger by incoming funds can be fantastic. But when it comes to your income, you might not want to have it triggered by incoming funds if you are getting paid on an irregular basis. So if you are getting paid every day, or you're having money hit your account every day or every couple days or on an inconsistent basis, triggering by incoming funds might not work best for you. But it works great if you're a W-2 employee or getting a consistent weekly, bi-weekly, or monthly paycheck that you know about how much is going to come in, because you can have that consistency set up. So as soon as the money hits your income source, those rules will instantly take place. Now, if you're a business owner or you have very irregular income, trigger by date can be better because it can help you even out that revenue roller coaster or that fluctuating income. And again, you have the choice to do it daily, weekly, bi-weekly, monthly. You can trigger these rules on any type of date combination that you want. Right now, we're going to go through an example of somebody making a bi-weekly paycheck. So I will trigger this by incoming funds, meaning as soon as money hits this account, these rules will run. Now, what we can do when we get into our first set of rules, if I click on the rules here, you'll see a couple different options. We've got transfer a fixed amount, which is self-explanatory. We will pick the amount of money that we want to transfer to said account. Anytime we are transferring money, we can always add a limit as well. So when you are transferring a fixed amount, you'll always see this add a limit option, because imagine in this case, we want to transfer a fixed amount of $1,000 to our emergency savings account every single time we get paid. And again, this is somebody who's making bi-weekly paychecks. So this would be twice a month in most months. You could say, I want to make sure that I'm transferring $1,000 every single time to the emergency savings, but we can also limit that to a certain amount per transfer, per week, per month, or per year. So maybe you say, well, I want to make sure it's no more than $10,000 per year. This limit runs on a per calendar year basis. So in that situation, it would say up to $10,000 every single year would be going to your emergency savings account, but you don't have to use that. What the limit is best for is one of our other rules, which we'll get to shortly, which is top up. So we've talked about the transfer fixed amount, pretty straightforward, right? It is literally you defining the amount of money or up to the amount of money that you want to send. Because one other piece you'll notice when we're transferring a fixed amount, what these rules look for is that exact amount in the account. So in this case, the $1,000 we want to send to our emergency savings. If this is not selected, what this says right here is this action will transfer exactly $1,000 to the emergency savings, providing you have sufficient funds to cover it. If you do not check that box and there is not $1,000 when this rule runs, it will not run because it's looking to make sure it has at least $1,000. If it is not there, it will not run. It will move to the next rule that we create. But if we check this box, what it says is this action will transfer any available funds from our income source to our emergency savings up to $1,000. And now you can also check that by always running your rule simulation. So what we'll do now is we'll put in $900. So that would be less than the $1,000 we want to transfer. We can run that simulation and we'll see that all $900 does in fact go to the emergency savings. However, if we unclick this box and we now run that simulation, you'll see that $0, there were insufficient funds, so the rule was stopped. So again, this button can be a great one to check on if you want to make sure that at least some money is getting into your account. Heaven forbid you have less than the full amount that you're describing. So that's transferring fixed amount. Now, the next piece is transferring a percentage of incoming funds. Now, this is pretty straightforward as well, right? A percentage of the amount. Obviously, we can't transfer 1,000%, but what we're able to do here is we're able to break down the percent of all of the money that's in there. So we could put in 10%. And if you want to continue to break down the amount of percentages and send all of your account's money based on percentages, you certainly can. You can click add an account. And let's say we want to send 50% to our personal checking account. We'll just simply find it on here. I want to send another 30% to our discretionary spending account. And I want to send the remaining 10% to our surplus debt and investing account. I can do exactly that. So again, I can run this rule simulation. Let's say we make $10,000 this paycheck, and we can see exactly how that sorts out. It's $1,000 going to the emergency savings, or 10%. We've got 50% going to the personal checking, 30%, and 10%. And again, you can see how that changes. If we were to make a different amount of money, obviously it's calculating it appropriately to make sure that the right money is going in there. Now, one question that comes up quite often when it comes to breaking down percentages, one thing you want to realize is this is transferring a percentage of the incoming funds. Because this is rule 1, rules are running in chronological order. So since it's rule 1, it is taking a percent of the total dollars that are going into this rule and breaking it down. However, if I were to delete these other pieces and we just have rule 1 running with 10% to the emergency savings and instead added another rule, we're going to transfer a percentage. And here we do 50% to our personal checking account. We do 30% to our discretionary, and we do the remaining 20% to our surplus. Now, if I am to run the rules, you'll see something different. So that same $10,000, we're seeing $1,000 going to the emergency savings, but then we're seeing $4,500, $2,700, and $1,800. Now you might be asking, why is that? Well, here's the key. What you're seeing right here is because we created another rule, rule 1 is completed, the $1,000 transfer to the emergency savings, but rule 2 is now taking a transfer of a percentage of the remaining income funds. So we transferred $1,000 of that $10,000. Now this rule is running off $9,000. So it's taking 50% of $9,000, 30% of $9,000, 20% of $9,000. So that's one thing you want to remember. If you want to account for all 100%, you can always add the accounts in the same rule. But if you create a rule that runs and then add in an additional rule where we're taking a percentage, it's always a percentage of the remainder. So that's one thing to keep in mind when you are using percentage-based rules. Now, one thing I do like to do when it comes to our percent-based rules is always having 100% of the remainder going into a surplus or a holding account so that you have that money set aside. You don't need to do that. Some people will leave the money inside of their income source, but the reason I like to use the everything going, or at least a certain percent of the remainder going to the surplus account, is because that gives us an extra account where we can pull from later in the month if we do overspend. Or at the end of the month, if we haven't used it, we can sweep it out into our investments, into our debt pay down, or into any of the other goals that we have. So one of the rules we get the most questions about is the round down rule. It's not necessarily as intuitive, but I think you'll understand it pretty quickly here. It's essentially the opposite of top up, which we'll cover here in a minute. But the round down rule, as you can see it right here, is going to take a balance that you describe, and then it's going to take anything above that balance and run it through the rule. Let's say you make $10,000 every single month, but sometimes you get a commission check or you might get a bonus because you worked overtime. Well, what you can do is you can use a round down rule to send any extra bonuses or any extra money that you've made over the course of that month to, for instance, your emergency fund or your surplus account or your investment account. And then it will run the rest of the rules on the remaining money. So in this case, to do that exact process that we just discussed, we're going to round down our income and we'll say the balance above $10,000, we want to go to our emergency fund. You could, again, send it to any of your investment accounts, your surplus account, but in this case, let's just send it to our emergency fund. And again, I can add a limit because maybe I don't want to send unlimited amounts of money if we have a really good year into our emergency fund. So in that case, I could cap it at $25,000 per year, per month, per week, or I could even cap it at $2,000 per month, just to make sure that not too much money is going into the emergency fund. Now, when I create the next rule, what I can do is I can use a fixed amount, and I'm going to say I want to send $5,000 towards our personal checking account, because this is typically the account that we're going to be paying most of our bills and recurring expenses out of. And again, I'm checking the box to transfer up to. Now I'm going to send a fixed amount to our discretionary spending. Let's say we want to make sure that we don't spend more than $3,000 per month on our discretionary spending. And again, I'm going to transfer up to $3,000. And then what I like to do again is transfer 100% of the remainder into our surplus, because I'll show you here in a minute how we can leverage that surplus to make sure that we are never running out of money and always have extra money set aside, but also can sweep that into our investment accounts, our debt pay down, or any other goals that we have. So when I set up this rule, what I can do is I can test this out with rule simulations, and we'll see what happens when we make $10,000. You'll see these rules. Well, it didn't round down because we had $10,000. So the first rule didn't happen because there was nothing over $10,000 for it to round down to. Then it was $5,000 to the personal checking account, $3,000 to the discretionary spending, and the final $2,000 going towards our surplus. But if we were to have a great month where we make $14,000, and we run that simulation, what we'll see is $2,000 is going to the emergency savings. You might say, well, why wasn't it all $4,000? Well, because we put in this limit of $2,000 per month. If I remove that limit and run that simulation again, what's going to happen is all $4,000 over the $10,000 round down that we wanted to are going to be going to the emergency savings, $5,000 to our personal checking, $3,000 to discretionary spending, and $2,000 to the surplus. And so you're realizing any of that extra money that we're making, we're putting into the emergency savings. But again, if I were to add back in that limit and I want to cap it at $2,000 per transfer, and I run that simulation, since only $2,000 is going to the emergency savings, you'll actually note an extra $2,000 went into our surplus for debt, investing, or any of the other goals that we have. So again, great way to be able to keep a consistent amount of income so that you are funding all of the priorities that you have, while also making sure that you're funding an emergency fund or putting it towards any other of the goals that you may have. Now, the last rule that we have, which is one of the most popular tools, is the top up rule. Top up is a fantastic tool, especially for things like emergency funds, because what this is doing, as you can see down here, it's saying this action will transfer any available funds to the emergency savings to reach a balance of whatever you define. So let's say we want to get our emergency savings up to $100,000. Well, what we're going to do here is, in this case, the first rule is going to top up that account. It's going to look at that account balance when it comes time to run the rule. If it's below $100,000, it will put as much money as you have into that account. Now, the issue there is that obviously you don't want all of your money of all of your paychecks going into your emergency savings every single time until you hit your threshold. So that's when you want to make sure to add a limit. If we are topping up, what it means is it's going to keep looking and keep filling that account with all of the accessible money it has until it reaches that amount of money, in this case, $100,000. But if I add a limit, what I can do is I can say, okay, well, we're going to do that $2,000 per transfer or per month in this case. So now when I run this rule simulation, and we can do it again for our $14,000. We'll see the rule, and it's going to add $2,000 to our emergency savings because we're still below the $100,000 threshold. It's going to send $5,000 to the personal checking, $3,000 to discretionary, and $4,000 to debt and surplus. And now let's take a look. What if we have an amazing month and make $100,000? Well, we can run that simulation. It's $2,000 going to the emergency savings, $5,000 to checking, $3,000 to discretionary, and $90,000 to our surplus account. Now, again, if I were to remove that limit and we run that same $100,000, well, what it's going to do, it's putting in $56,800 into our emergency savings because that gets it exactly to $100,000, then $5,000 to personal checking, $3,000 to discretionary, and $35,200 to our surplus. So again, top up is fantastic because it's essentially a set it and forget it. You define what you want in your emergency fund or your discretionary fund or your investment account, whatever it may be, you're able to top it up. It will look at the balance of that connected account. If it is not yet to the limit that you want it to be, it will put in as much money as you define, either every single dollar until it reaches that amount, or you can add a limit to make sure that you're not sending too much of your money each paycheck, each month, each year into the connected account. But again, top up is a fantastic tool, especially for emergency funds, because once it's filled up, you don't need to worry about it. It will skip that rule and the remaining money will flow down to the following rules. Now, we do have additional rules. You can see these dynamic transfers. This is when we're getting much more advanced, and I wouldn't recommend this for most new users, only when you're really trying to dial things in or take it up to a level. In fact, I don't think most of our users would ever need this, but we have plenty of people who love to absolutely manage their finances as detailed as humanly possible. But what we can do is we can actually transfer the current balance of another account. So this can be really useful if you're paying off debt. So maybe you have a credit card and you want to make sure that you are transferring a specific amount of money based on the actual credit card balance that you have on there. Well, we can transfer the current balance of another account. You can also transfer the last statement balance of another account or transfer a minimum payment due from another account. And so what I can do here is I've added in 2 additional liabilities. That we have a MasterCard and a Wachovia bank card. Now, to show you these additional rules, I'm going to click on the existing rules that we have, and I'm going to create a new rule. And now again, all of these rules run in order. So if you ever want to change the order, in this case, our rule 4 transfers 100% of whatever's remaining after the first 3 rules into the surplus and debt. So any rule I create after that is not going to have any money because we're already transferring 100% of it to surplus and debt. So if I'm going to create another rule, I just simply need to click and drag it above this final rule where 100% is going to the surplus. In this case, if we wanted to test out some of the additional dynamic transfer rules, I can transfer a current balance of another account. So I'm going to click on that. I'm going to find the account. In this case, we had the Wachovia card. And I can say transfer current balance of another account of the Wachovia card to our personal checking account, because maybe I want to make sure I have extra money inside of that account to accommodate for the credit card bill that's going to be coming up. And I can transfer up to the current balance. Again, this is that same version of the transfer up to $3,000. This is just saying if we don't have enough money to cover that full balance, transfer as much as we have in order to cover that balance. So now what I'm going to do is I'm going to add a limit back into our top up of the emergency savings because we don't want every dollar going into the emergency savings. We'll cap it at $2,000 per transfer. And now when I run the rule simulation, we'll use that same $14,000 that we did previously. When I run that rule, what we're going to see is that $2,000 goes to the emergency savings, $5,000 to the personal checking account, right? Because that was the rule that we defined right here, $5,000. Rule 3 is $3,000 to discretionary spending. And then what we're doing is we're actually transferring the current balance of the Wachovia card to the personal checking account. So it's sending another $2,300 to the personal checking account. And then whatever's left, in this case, $1,600, almost $1,700 is going to the surplus debt investing account. So now what that's doing is that's allowing me to not only pay for my fixed expenses like the mortgage, the car payments, the insurances, but also setting an appropriate amount of money aside to my, in this case, Capital One checking account, because we're assuming that that's the account that you're currently paying that bill out of. So again, you don't need to pay your bills or connect all of your existing liabilities to Sequence because most people, in fact, are already paying it out of their existing checking account. And especially when you're getting started, it can be daunting if you are creating individual accounts and connecting every single liability and changing where those accounts are getting paid from. Because when we connect them into Sequence and you start creating rules, you're creating new accounts that are funding those accounts. And most likely, your accounts, your credit card, your mortgage, all of these different places are already linked to your existing bank account and pulling the appropriate amount of money each month. What we're able to do is help you pay additional money towards it. We certainly can send the money to it, or you can connect that account to your new Sequence account to pull from it. But from a getting started perspective, it's often easier for new users to just keep their payment structure the same so that they're not having to go into their American Express or their Wachovia card and change the routing and account number. Instead, they'll continue to pull from their existing account, whether it's their mortgage, their car payment, their insurances, or their credit cards. But then we can also send an additional payment to those cards or those liabilities or those financial service companies to help you pay those bills off faster or to eliminate your debt quicker. So in this case, we're just making sure that we're sending the full amount to the personal checking account. And as you can see here, that's that 2327 because it's looking at the current balance and it's sending that additional money to the personal checking account. So not only will the bill be able to be paid in full, but the remaining amount of money that we need for all of our other fixed expenses are going to be coming out of that account as well. So that's a great additional tool that we've got inside of there. And that is the transfer current balance of another account. You'll see the same thing, transfer last statement balance of another account. So it's the same type of rule. In fact, we can test it again, $14,000. We'll run that simulation. And here you're seeing the same amount because that was the last statement balance. Now we will do the last rule, transfer minimum payment due from another account. And if we run that rule again, well, in this case, it's the same 2,000 to the emergency savings, 5,000 to personal checking, 3,000 to discretionary spending. But in this case, it's only $98 because that's the minimum payment due for that account. Now, it might not be the best idea to be only paying your minimum payments, but just to give you an idea, we can all of a sudden make that happen. Minimum payments might be better for your mortgage or for other pieces that you're connecting. Certainly not high interest debt like a credit card debt. But again, I just wanted to show you how those different dynamic transfers can work. What they're doing is you're allowed to transfer money, or it enables you to transfer money to an account based on a different account that you are not necessarily sending that money to. Now that we have the basic map set up in this situation, I want to show you a couple other tips and tricks that I think can be really helpful leveraging the rules to make sure that you're never running out of money or never in a bad situation and nervous about where your money is. So since we have separated our fixed expenses versus our discretionary spending, and I'm actually going to change this because this is our personal checking account, but I'm going to call this fixed expenses. It's still our personal checking account, but I think it visually helps us remember what each account's purpose is. What we can do is, since we're sending the appropriate amount of money to our fixed expenses, and what I would always say is typically have some extra amount of money, some wiggle room. So if your fixed expenses are $5,000 per month, well, let's put in $6,000 into it just to make sure that you're accommodating for any increase in an electricity bill, or your insurance goes up, or maybe there's a quarterly bill or a semi-annual bill that you had forgotten about. You want to make sure there's enough money inside of that account. So I always like to add a little bit more money each month so there's appropriate wiggle room. Now, when it comes to discretionary spending, since this is probably the first time that you've separated your fixed expenses from your discretionary expenses, most people have their paychecks land in their checking account, and then they're spending all of their money for all of their bills, all of their recurring expenses, all of their fun money, all of their travel, all out of that same checking account. That can get really easy to overspend. So what we tend to like to do is create this secondary account. In this case, it's a pod, because we can order our own cards from that account, both a virtual card as well as a physical debit card, so that we have it like you can see here. This allows us to make sure that we're only spending the amount of money that we want to make sure we're spending. We're not looking at an account full of $14,000 like we would have otherwise in our examples. What we're doing in this case is we're only sending $3,000 into this discretionary spending account so that we're able to decrease our luxury expenses. Now, you might say 3,000 is not enough. No problem. As always, these numbers are entirely editable. You can change them however you would like to make sure that you're working within your means. But what I want to show you is, because we are sending money to this surplus account and not doing anything with it yet, what I like to do is I like to create an additional rule from the surplus account to our discretionary spending. And what I'm going to do is actually trigger this by date, because I am going to actually set up a daily rule where I am topping up. I'm not transferring a fixed amount or a percentage. I am topping up my discretionary spending to a fixed amount of, in this case, let's say $500. So what that's doing is it's going to, at midnight every single day, look at the discretionary spending. And if it ever falls below $500, it will put in more money until it reaches $500. Now, you might want $1,000, or in this case, it looks like I typed $5,000. Again, completely up to you. But what this does is essentially helps make sure every night that you're not going over or under your spending limits, so that we're making sure that there's extra money in there. And again, as always, we can add a limit to this so that we can say we want to cap it at $1,000 per transfer or per week or per month. Again, it's up to you. But in this case, we have topped up the discretionary spending to a fixed amount of $5,000, meaning it's going to look at it every single day. If it's below $5,000 at midnight, it will put in this case, up to $1,000 because we added that limit until it gets to $5,000. So great way for you to do a daily check-in, a daily top up to make sure that your money is still there. Heaven forbid you happen to overspend one day. So let's take a look. Let's say we had $4,000. We can run that simulation and it will still move $1,000 into the discretionary spending account because we set up that limit of $1,000 per transfer and it was below $5,000. So again, that's a great way for you to add in some purchase protection so that you're making sure that you have enough money inside of that account, and heaven forbid it slips below some threshold that you want, you're able to top it up every single day. Okay, so now that we have addressed all of the different rules, moving from income source to pods and to external accounts, I want to show you the last part of this map because we've already sending money to our emergency savings. We're sending it to our fixed expenses. We've separated our discretionary spending and have set that up. We've sent the remaining money to the surplus account, which is going to daily check the discretionary spending to make sure we top it up. So we've got all of that taken care of. Now what I want to show you is the next set of rules and how you can set this up for what happens with the surplus money. Now, remember, in this situation, we have this rule triggering, our initial sets of rules triggering as soon as money hits. And we talked about a situation where the person was making biweekly paychecks. So this money was moving instantly when that money hits their account from their paycheck. Now, what you can also do is we can start to create rules. So when we have this surplus money, we can actually start to create the sets of rules that we want to take action when that money has been there for long enough. Because again, if we were to choose trigger by incoming funds, as soon as money hit that surplus account, it would then go out based on the rules we set up. What I like to do in this situation is trigger by date, because now what we can do is we can set this up for a monthly queue or a bi-weekly queue or a first and the 15th or a custom queue. So what we can essentially do is we can have this money setting inside there and then allowing us to sweep it out if we don't need it at the end of the month. So if we have not spent it at the end of the month, and I'll show you exactly how to do this, what we can do is last day of the month, we can transfer a percentage, and let's call this 50% of it's going to the brokerage account. So in this case, I can transfer 50% to the brokerage account. And that way, at the end of the month, if the money is left over, 50% will be going to the brokerage account. Now, the interesting thing, the rules we haven't showed you is when we actually connect a rule to our liabilities, what you can do here, I'll trigger by date, you're going to see an additional set of rules. You're going to see transfer a fixed amount, transfer a percentage like before. You're going to round it down like we already discussed, but you're also going to see things like execute debt Avalanche, execute debt Snowball, pay the current balance, pay a percent of the liability, pay minimum payment due, or pay last statement balance. So we did see a couple of these iterations when we were using the dynamic transfers previously. But as you can see here, you can use things like debt Avalanche, which if you're not familiar, this says it right here, this action will use however much money we put in, to pay the minimum amount of each connected liability that you want to include, and all remaining funds will be transferred to the liability with the highest APR. So in this case, if we wanted to utilize a percentage of the balance, in this case, it's 100% of the balance between the MasterCard, and I'll add one more account, in this case, the Spinwheel Wachovia card. What I can do is I can run this rule and you can see exactly what will happen. So imagine we had $5,000, or no, let's make it less because the actual total liability is less. Say we had $2,000 in the surplus after money goes to the brokerage account. When we run the rule simulation, what it's going to do is it's going to put $100 towards the MasterCard because that was the minimum payment required. And then the remaining $1,900 is going to the Spinwheel Wachovia. And that's because it has a higher interest rate. And that's what the debt Avalanche process is. It's got a 38% APR. And if we aren't able to track your MasterCard, we could certainly put that in, update it to 18%, whatever it may be, but that is executing Debt Avalanche for you. Now, again, Debt Snowball, very similar, but the only difference is instead of looking at the interest rate, it's going to look at the actual debt balance. So if I were to, again, connect the Wachovia card here and run this rule with that same $2,000, what you'll see is the full $453.26 of the MasterCard is getting paid off because that's Debt Snowball. It's paying off the lowest balance first and then using the remaining funds to snowball down. And then it's putting the $1,500 towards the Wachovia card. So again, two great strategies, best to use whatever you see fit. You don't need to use either of them, but again, we've got that pre-programmed into the software for you. And again, we can pay the current balance. We can pay a percentage of the liability. These are all pretty straightforward. You can pay the minimum amount due or the last statement balance. And again, you do not need to connect your liabilities if you do not want to. Most people are already paying them out of one of their other existing accounts. So if you're paying off your credit cards each month, you don't need to do this as well. But if you're in credit card debt or you need to eliminate debt and you want to continue to make your payments from, in this case, your fixed expense account, but also make an additional payment towards those cards, that's a great way to leverage the surplus account to then create a sweep function at the end of the month or after the money has been there for a week or some time that you no longer need it. We can then sweep that money to pay off the debt, to increase our investing, or to do whatever we want with it. So again, you don't need to connect your liabilities if you are already paying your cards off and your mortgages off in a responsible and timely manner. But if you want to add an additional payment, you certainly can do that using these rules. And as you can see here, when it comes to the frequency schedule, typically these liabilities are paid monthly, so we can say monthly, and we can do this on the last day of the month. We'll click save, and just like that, we have everything set up. Now, the one thing I'll note when it comes to really refining your rules, because we created these initial rules from our income source to all of our core accounts triggered instantly, could be paid on the 1st and the 15th one month, but then it might be the 5th and the 17th, whatever it may be, 19th. There's going to be some fluctuations in when those rules run because it's a 26-week pay cycle. So in this case, by me creating an end of the month transfer, it doesn't necessarily mean that that money is going to be sitting there the entire time. What I like to do personally is, as long as you have enough money to be okay and you're not living truly paycheck to paycheck, I'm a big fan of creating these initial sets of rules from our income to everything else on a trigger by date, where I can now do this either bi-weekly or in my case, monthly. So what I will typically do is I will create a monthly rule on the 1st. That's when all of the money will be distributed. So it stores up inside of the income source. On the 1st of the month, it will distribute those funds. And then that way, when I set up the rule coming out of my surplus account to go to the brokerage to pay off the debts, whatever goals we may have, for like a vacation fund or funding childhood education, whatever it may be, that way I can set up the next set of rules for the last day of the month. So I distribute all of our funds to all of our core accounts on the 1st of the month. That money sits inside of the surplus account. In case I ever need it, it's able to top up the discretionary fund. And then on the last day of the month, right before we get our new distribution, it will sweep the surplus money into whatever goals we may have. In this case, the brokerage, the MasterCard, and the Wachovia card. So again, just to highlight the differences in the ways we can set up these rules, it can be fantastic to have the income transferring immediately. If you want to set up a surplus account that then sweep aside, there may be some advantages to doing things on a monthly or bi-weekly basis. So I know we've covered a lot in this. Hopefully this gives you a lot of more clarity into how to leverage all of the different rules inside of Sequence. We're going to continue to put more and more of this content out there to make sure that you guys feel incredibly confident in understanding how do you build the best map for your situation. What we'll be doing next is creating another one of these journey maps through the business owner lens. So what we went through today was largely personal finance, but as you can see, a lot of these core principles and the rules hold true whether it's personal or business owner, but we'll show you how you can set up some of these neat tips and tricks like refunding and topping up your discretionary spending inside of your business to make sure that you're able to leverage those same logic and smart rules to increase your and improve your business finances. So thank you so much for joining. And if you haven't tried out Sequence yet, make sure you sign up now and make sure you sign up for one of our upcoming webinars where we'll be diving in deep to more tips and tricks when it comes to leveraging Sequence to improve your finances.